Hey guys, welcome back, Sound Financial Family. I'm Paul Adams. This is Your Business, Your Wealth, and I've got with me Corey Shepard. Now, for those of you that don't know Corey Shepard, this man is the very man who made the suggestion before we met today. He said, Paul, summer's almost over. Fall starts September 22nd. Sun's out, guns out, sort of. We're wearing short sleeves in a professional environment today, and I'm so excited.
I'm here today with Paul Adams, the king of saying I said things that I didn't say. All I said was, I like this shirt. This is what I'm wearing. And I'm glad that he got this out of his system already. He proceeds to, so let me unbutton my shirt. No, that's not what I said. He said, I'm wearing this is what I'm wearing.
Listen, for all of you out there in the audience that wanted to see me with my shirt off, your disappointment today can be pinned on Corey. One Corey. All your upset can be a Corey. Well, y'all, we got one phenomenal article today that ties into a bunch of our philosophy we're looking forward to sharing with you. Corey's going to introduce us a little bit.
This one in a long time. This is one of my favorite article titles in a really long time. And it's from our friend Mr. Jason Zweig, which I hope, one day I think we're going to get him on the podcast. We're going to do enough of his articles. And I really like his perspective. He's good at bringing great content that actually makes sense. How to beat the stock market without even lying. So the subtitle, I'll read the subtitle real quick. Stock funds have been pulling a switcheroo to make their returns look better. When they don't measure up, they change how they measure. And
now
that's
amazing. To give everybody a little bit of context, we're going to go into a touch of our philosophy today that you guys can see in our Illusions of Investing videos, where we talk about the major illusions that big box financial retail teaches to individual investors and how you can overcome them. Now, we're going to be hitting on one of those today, called survivorship bias, and the idea that most funds don't outperform their indexes, coupled with the way that the mutual funds are able to make that perhaps look better from their company than others, is by shutting down those funds, which Corey's going to talk about more here in just a moment from some research from Morningstar. But this is like the big stat. Many of you have heard this before, but it's simply that actively managed mutual funds, what they try to do is they're like, we're going to try to beat this index. And they voluntarily say, this is the one I want to be compared to. And it's 23% of them over a 20-year period beat the benchmark that they were saying that they were going to beat. And
they get to pick the benchmark.
They get to pick it. And the other thing is that even in this study, I don't know if I shared this with you, but I ran across an article a while back, Corey, that most of them that do beat the index, I think it's from Morton Housel's Psychology of Money, that even when they outperform the index, it's almost always because they had 2 or 3 really incredible years in this time span that worked out extra well for them. And it wasn't that they had a consistent performance above and beyond the index they were being compared to.
Which, right there, that does say something to say the worst thing you could do is be moving around trying to use any of this data to switch managers, because best case scenario, you might get you get a manager that beats the index just because a couple of really good years, but you had to be there for those couple good years. So even if they did beat their index over a long-term period, if you were hopping around, you could have missed the key years that actually got you that index beating performance, right? So
exactly. Or you chased returns and went into it after because you thought it would continue, which, Corey, isn't that how companies get 5-star rated funds, is because they had high degrees of performance as compared to an index, et cetera, for a window of time? Hint, hint, segue.
Well, and the thing I don't think we've actually mentioned yet about this article is 37% of all funds from, what did Jason say, 2006 to 2018, 30% of all U.S. stock mutual funds changed the index that they chose to compare themselves to. So, if you were comparing yourself against an index that got 20 and you only got 10, you look awful. But if you could change to an index that got 5, now you look great. And so it's like, wait a second. And there is a regulation that says when they change, they have to keep the old one next to the new one for a year, and then they can switch to just the old one. But I don't think that's even going to stop anybody. It's like, oh, well, here's this other one, but this is the one that we really care about and we did better, and this other one's very different, like that's not going to be a problem. So the thing about using past performance, so that's the definition of like using past performance to create the image of a better result. This is a chart from a study of Morningstar ratings. Now, if you're not familiar with Morningstar, you might have seen their name or might see their name amongst all your 401k materials. If you get those things in the mail that you just throw away again, that talk about the different funds that you have access to, because they rate mutual funds and other stocks and do a lot of different analysis. So this graph is showing in December 2007, north of 14,000 mutual funds out there, and only about 1,000 got that 5-star rating from Morningstar. And then there's the 4 stars is the next down, 3 stars, it kind of stair steps down. And so the idea is, if there was some kind of correlation between this star rating and performance, we should see that over time. And so for the next 5 years, these stocks were all followed, and you'll see color coded and lined up with the other ratings, like right below the 5 stars is a graph of all the scatter plot of all the different funds and how they did over that next 5 years.
So 5-star fund only tracked over the next 5 years.
Track them. Those are all little dots, 1,000 little dots. And to make it even, this isn't just like what rate of return they got, but what their rank was in their category. So 2 of these dots at the very top could be a bond fund and a stock fund, very different expectations for rates of return, but like what percentile rank were they in their category? And I don't know, I'm not a mathematician, so I acknowledge that I don't have 100% authority in making this assessment, but gosh, it looks fairly random to me. If at least not perfectly random, we don't see any kind of crowding near the top. And here's what I would think we would see is kind of, maybe it's not perfect, there's always outliers, but a significant squishing towards the top for 5 stars, and then 4 stars would maybe have a band that runs a little bit worse, and then 3 stars should have a crowding a little bit less than that. But we just don't see that. Like, it looks fairly randomly distributed until we get down to 2 stars and 1 stars, where 2 stars seem to be a little lighter at the top and heavier on the bottom, and 1 star, it's really a lot heavier on the bottom. So maybe the moral of the story is, can't always tell if you're really good, but if you're really bad, you smell, and it's easy to tell, and you're going to stay bad. Except there were still winners, a decent amount of winners at the very top of the heap in the 1-star category. So
and even if that's true, it doesn't help us with our investing because nobody's trying to get a 1-star fund.
Right. Well, there are like someone out there is like, I'm the contrarian investor and I just do the opposite of everybody else and I'll buy all the 1 stars. Except that does seem a more sure path to worse performance than any of the others, are a path to up performance if you're going contrarian to Morningstar's fund ratings. But the moral is the same moral that is printed on the bottom of every piece of client collateral from every investment firm out there. Past performance is no guarantee of future results. But what is more an example of trying to look at past performance to guarantee future results than doing an analysis of what a fund has done so far and then giving them a star rating to help you pick, right? You're just picking based on what happened in the past. So these fund managers, back to the article with Jason, are They can't change their. Oh, go ahead.
Right before we go back, for the people that are watching the video and not on audio, of those nearly 15,000 funds, because remember, this is a tracking for the 5 years following 2008, 9, 10, 11, and 12, 5 years. In that period of time, for those of you looking at this, wondering what this means, that means there were 4,269, about a third of all funds were killed during that 5 year period. And they don't send their investors the money back. They move the money into another fund that they manage, and they'll send you a letter. Most of you have been investing for more than like 8 years. Have probably got more than one of these letters. You might have got it on your 401k, but it's like, it says something like, hey, here at ABC Mutual Fund, because these two funds had similar management philosophy and better economies of scale and combining them, and an aligned management team, or some other like corporate hogwash, and you get it. It sounds kind of good, but what they're actually doing is taking a poor performing fund, putting it in a good performing fund, and when you get your next statement, your historical performance it's going to show you is the new fund. And they are able to wipe out their old fund performance. So anytime you see somebody say 75% of our funds outperform the Lipper average, what they're actually meaning to say is 75% of our funds that we let live.
Right. So they're saying that 25% we close down. And they don't close down every single one that underperforms for 1 year.
Yeah.
But we have our classic example when we used to do in-person events, was giving everybody at every table at the dinner a coin to flip.
Yes.
And saying you're all newly minted fund managers. Each quarter represents $10 million. Like, you just got your CFA, passed the test. Here's 10 million, kid. Let's see what you can do with it. Everyone flips their coin. If you got a heads, you beat the market that year. You got to keep your money and keep your job. If you hit a tails, you underperform the market, and you have to give that coin to someone else and sit down, which is a great visual representation of what happens in the fund world. They start 5 or 6 funds all at the same time. They don't know which one. They know they won't know which one is going to do better, or else they would start fewer. And then after a few years, the one that has the better track record gets all the assets of the other one. That's good from a growth standpoint, by the way. Like, our fund has grown from this to this over this period of time. Well, mostly it's from money already had from other people. It's not.
And they'd start marketing it. Like, you guys ever wonder why you don't see a fund in your mutual fund? Like, the reason investors don't see a fund in their mutual fund that has 0 years of performance is because they incubate them until they get one that worked out. And our record was 18 heads.
Yeah.
From a 62-year-old woman in a room of about 45 people. And what we told our audience was like, how do you think the Fidelity Magellan Fund happened? It crushed for many, many, many years and then fell off. Why? It's a statistical anomaly that they outperformed the average because there is no consistent or predictable way to know who will outperform the market. Now, all of that.
And even Peter Lynch, like, maybe he did have a magic wand, maybe, and he was the one that did. He wasn't actually lucky. He knew something that no one else knew. The one. Because there haven't been, I don't know. I haven't looked at this in a while, but has anyone else had a 15-year beat the market every time track record since then?
Peter Lynch,
look at that, but I don't think.
And the guy, Jim, whatever, that's talked about in Morgan Housel's book.
Oh, yeah, right.
But, and then, Warren Buffett's had a good run, but I think one of the biggest reasons he did, nobody could move their money out. That's his special sauce, is nobody could take money out of Buffett's fund.
Has he been positive every single year, like beat the market every? I don't think so.
Not every year. So
even if Peter Lynch had the magic wand, well, number one, why did he stop using that wand when he did? That's like, maybe the wand broke eventually, but you never would have known how to know he was the one, like, back at the beginning, because lots of other people had 1, 2, 3 year track records to match him. And so why would you have picked him over any of them? So it still doesn't give us a tool to figure out who we're going to stick with over the long term.
Indeed. So now to the article we've been teasing you guys with, in what they can do to make what already doesn't look good look slightly better, or the context that Miranda gave us, and so those of you who know, Miranda helps us in the background and helps us produce the show, and she's like, isn't this like if somebody gains weight and people say their pants don't fit, that they just go put on a different pair of pants that are bigger, and they're like, my pants fit now,
right,
instead of going and losing weight. So I'll read this part. There's a new study by finance professors Kevin Molani of the University of Central Florida and Adriana Rossi of the University of Arizona finds that between 2006 and 2018, this is a stat Corey mentioned earlier, that all U.S. stock funds, 37% of all U.S. stock funds pulled this switcheroo of switching which index they were compared to.
So it's not everybody.
And this is also curious to me, Corey. In as many as 2/3 of the cases, funds made past returns look better by changing the benchmarks they compared themselves to. So at least there is some of them are trying to be straight about it, because at least they're saying some of them changed it to a situation that was either neutral or worse for them.
Yep. Yeah, it's and so like he notes, at one point, I love this part. He's like, I wasn't sure whether they were going to change to a new index that made them look better, or it was higher or lower than what their performance was. But then I found
I wasn't shocked.
Hilarious. I wasn't shocked. Yeah.
And this is also curious. Determining which index is appropriate is more or less up to the managers. And they can change their benchmarks without much explanation. And he gives, we'll give you a couple of specific examples. Where is that index measure performance? Existing. Here we go. In July 2018. So here's, for a dramatic shift in comparative results, consider parametric dividend income fund, which, by the way, talk about like assembling some kind of word salad to sound like a very intellectual fund. The parametric dividend income fund. I think it should like have some theme music behind it when I say it.
Right.
In July 2018, it switched benchmarks from the NASDAQ US Dividend Achiever Select Index, a basket of companies of various sizes, to the large company Russell 1000 Value Index. However, the fund continued to specialize in high dividend paying stocks selected from the Russell 3000 Index, which includes small, mid-sized, and large companies. As a result of the switch, the fund's 2019 prospectus showed it beating its benchmark, an average of 1.5 percentage points annually since inception in 2014. So here comes the angry Paul coming out. It's like, what the actual heck? Like, they don't even have to say we underperformed in all these years under our old one and then get a new comparison. They can actually just say, no, we did great all the way back to 2014 compared to this index. This is the cloudiness of this damned industry for clients.
Right. I don't blame people for having mistrust of Wall Street and of financial institutions when this is the kind of shenanigans that goes on.
And it said, had the fund stuck to its original dividend focus measure, it would have underperformed by approximately 0.7 percentage points annually over the same period. So that's a difference of 2.2%. And people will tell you like, oh, an extra 0.5% in fees can really affect your performance. Well, how about 2.2% of undisclosed difference in performance?
Yeah. Right.
And she said, a spokeswoman for Parametric said the fund changed its benchmark because it's a better match for the strategy and allows investors to more easily compare the fund to similar funds. And then Vanguard Energy has changed its benchmarks 3 times since 2000. But what Vanguard does, and I got to give them props for this, is they will show a spliced benchmark that include the old and new indexes. But I think where we could end is this last line. Prospectuses always warn that past performance is no guarantee of future results. Turns out it's no guarantee of past results either. I love that. Jason Zwig, that is, I think we're going to get along well, Jason, when we meet, because I think you're as much a troll of our industry as we are. like willing to point out what's wrong. And that last line is absolute gold. That's how we know you're a great writer, because that last line, I got to read it again for the people that are just audio. Prospectus is always warned that past performance is no guarantee of future results. Turns out it's no guarantee of past results either. That's it.
So good.
And so you kind of the thing, I think, not to speak for Corey, but he'll say if I'm off, is that it's like it's so cloudy and it's so difficult to see through this stuff. If you're out there and you're working with some other financial advisor, check in. Ask them where they get their education. Do they go to financial conferences sponsored by financial companies? I just got an email Friday.
Good one.
Inviting me to that due diligence trip to look at this particular fund company. And it's 3 nights, and I'm welcome to bring my spouse to Sonoma. I've never been to wine country. It sounds pretty cool.
Right.
But what is the obligation they're building in the advisor?
Paul, I never told you, like I got invited to a salmon fishing in Alaska from some fun company that I've never talked to before. They don't even know me, but they're sending these invites.
They know
we're friends. Like, hey, we'd love to have you.
You bet.
There.
That's our public disclosures of the amount of money we manage. Like that's what gets us those emails. And and I got to tell you, like if a fund company wants to send us an invitation to go bear hunting in Alaska, I'm going to be tempted. I'm still going to say no. I just want to say I'll be tempted. If I'd have got the salmon fishing one, Corey would have been like having to talk me off it.
Yeah.
But these are the kind of things that advisors get approached with all the time, where they can make the pitch for their funds being in your portfolio to the manager. And most managers don't know about this. Most advisors, have no idea about the survivorship bias and the closing of funds.
Right.
I've had advisors argue with me about that and then shown them the proof, and that rocked their world. They sure don't know about this, that they can change what index they're being compared to.
Right.
And it's not, they're not being, I want to be so, like, I don't think any of them are being dishonest, right? None of us think that. They're just not getting the full picture because they're not looking at the advice coming from the institution with the level of skepticism that we would want.
Right.
So with that, we don't have anything really cool for you guys to run and do today, but what you may want to do is keep track of what index are your funds in your 401k being compared to, and are they changing? But you talk about this article talks about it. The onus is on you as the investor. So it's like, what are you going to do? Keep the prospectuses every year and then check it against the last one? Or print out the Morningstar report and check it against the last one? And if you don't know, 2/3 of 37% of mutual fund companies did this. So odds are you own one that did this. And you probably don't know it. And what can you do about it? Go find an advisor that thinks like us. Go find an advisor that listens to our podcast. That'd be fine. Like they would at least be aware of this stuff, but it would be, do they really have an independent way to look at this kind of information? Because if they don't, then they're hurt in their ability to guide you.
Mm-hmm.
So I really wish we could leave people on a higher note this one, but this is just absolute. Like, and I got to say one more thing. This is not scumbaggery of the industry, purely. It's that could they do these things more accurately? Could they calculate this spliced, whatever? But the regulators are always behind the technology. So there is a way for them to fairly present it when they change them with the technology we have now that just didn't exist when they set these regulations and they're not catching up.
Yeah.
And think about this. This is the first time we've seen an article ever in a publication as big as Wall Street Journal talking about this. And it's been done for 30 years. So
That's wild.
If you're not making sure you really understand your decisions, that you know an advisor that is being critical of their own industry, and that may be appropriate in any industry. If somebody doesn't see a problem inside of their industry, like their industry is all good and just there to help people, it's like, then you might want somebody who's just more skeptical, and whether that's a mortgage person or something else. Like there are things wrong on the inside of any industry because the people at the top have too much money that they can make if a lot of people have a slight misinterpretation of the value or the performance of products. So we as individual investors, as we've talked about before on the podcast, got to be your own fiduciary. But if you want help being your own fiduciary, reach out to us or reach out to an advisor like us. And with that, we hope that this episode has been a contribution to you being able to design and build a good life. And we'll see you here next week.